Right, on the 6th of March this year, a 2-page form landed at company's house. No press release, no interview, no announcement. Form CH01, director's details changed, and on it, Anthony Joshua's country of residence quietly became the United Arab Emirates, 2-time heavyweight champion of the world, one of the highest paid British athletes ever. And as far as the paperwork's concerned, no longer living there now, he's never said why he moved. Not once. So I'm not going to tell you it's about tax, because that would be me making it up. The filing is public, the motive is his, but you're not a heavyweight champion. So why does this matter to you? Because if you run a UK limited company, the mechanism underneath this move, the double tax treaty between Britain and the UAE, is one of the most misunderstood pieces of paper in the whole leaving the UK conversation. People think it's a magic door. It isn't. And today I'll show you what it actually does, what it doesn't, and the bit almost nobody mentions, the tax that follows you even after you've gone. Quick one before we start, yes or no in the comments. Could you do it? Leave properly, family and all? If you run a limited company, subscribe. This channel tells you what advisors charge by the hour to explain. One thing before we get going. This is what I do for clients, day in, day out. The serious structuring at CT Private Office, the accounts and the compliance at Tax for Pros. If you want to get started with me, there's a link below. Back to the story. Here's what's actually documented. Joshua's main UK company is Sparta Promotions Limited, and its latest accounts landed at company's house in July. Year to February 2025, 41.5 million in turnover, 35.7 million of profit before tax, about 10 million of that gone in tax. And here's the detail that made me sit up. Dividends taken that year, 0. The year before, he took 10.4 million out. This year, nothing. The profit is stacking up inside the company instead, 166 million of it now. That company is still British, still files here, still pays corporation tax at 25%. Because here's rule 1 of this whole game, and write it down. Moving yourself isn't the same as moving your company. And in December, Joshua fought Jake Paul in Miami, knocked him out in round 6. The purse was reported at around $90 million each, and I'd treat that number gently, because Joshua himself suggested the real figure was lower. But wherever the truth sits, that fight was taxed in America because it happened in America. Hold that thought. It's the key to everything. So, the double tax treaty. Britain and the UAE signed it in 2016, and here's the myth. People think a treaty decides whether you've left. It doesn't. Whether you're a UK tax resident is decided by British law by something called the Statutory Residence Test. Days in the country, ties to the country. The treaty only shows up afterwards if you manage to be resident in both countries at once, and then it acts as a tiebreaker. The Revenue's own manual says the treaty doesn't override the fact of UK residence itself. They're words. And when you look at what the treaty actually hands an individual, it's a shorter list than the internet thinks. The genuinely valuable bit, pensions. Under the treaty, a UK private pension paid to a genuine UAE resident is taxable only where they live, and Dubai's income tax rate on that's 0. That's real. But dividends? Here's the honest bit that'll surprise you. The treater barely matters. Britain doesn't withhold tax on dividends leaving the country anyway. If you're genuinely non-resident, dividends from your own UK company can already fall out of UK income tax under our own domestic rules. It's the residence test doing the work, not the treaty. Now think back to that 0 dividend year and the 166 million still sitting in the company. I'm not telling you that's the plan, he's never said. I'm telling you what the rules do. Dividends taken while you're genuinely non-resident can fall outside UK income tax entirely. And there's a 5-year catch on exactly that move, which is coming up in a minute. Now the payoff. The bit that makes this whole story honest. Say Joshua fights at Wembley next year. Dubai resident, treaty in hand, certificate and all. Who taxes that purse? Britain does. Every pound of it that relates to that night. The treaty itself says so. Sporting income is taxed where the performance happens. And Britain enforces it brutally well. The promoter has to deduct 20% before the money even reaches him. And the final bill through a tax return can reach the top rates. It even catches money paid to his companies rather than to him. We know that because of a tennis player. Andre Agassi, his sponsorship money went from Nike, an American company, to his own American company, never touched Britain. The House of Lords ruled in 2006 that a slice of it was British income anyway, because he played at Wimbledon. If your income comes from performing, the taxman taxes the performance wherever the money routes. And it goes further than the purse. A slice of a sportsperson's worldwide endorsement income gets taxed here too, split by the days they compete and train in Britain. That's why the Miami fight was taxed by America, and why a London fight will always be taxed by Britain. The ring decides. Quick one for the comments. Would you leave the UK to keep more of what you earn? So let's bring it down from heavyweight money to director money, because the same rules run right through your company. Take £100 of profit in your limited company. Stay here, extract it as an additional rate taxpayer, and after corporation tax and dividend tax, you keep about £45.50, around 54.5% gone, across both layers, become genuinely non-resident, and the personal layer can fall away. The company still pays its 25, and you keep roughly 75. Same company, same profit. The difference is residence, done properly. And properly is carrying a lot of weight in that sentence. So here's what it costs. You don't need an island for most of this, by the way. The tax game plan is £9, and it's the same foundations I charge proper money to implement, link below. And if you're serious about the exit playbooks sitting next to it, 3 catches. Every one of them has ended someone's clever plan. 1. The day counts are vicious. If you've been UK resident recently, as few as 16 days back here in a year can be enough to drag you straight back into the net, depending on your ties. Family here, a home available here, work days here, each tie tightens the noose. 2. The 5-year rule. Leave, draw the money out of your company tax-free, wander back within 5 years, and it's all taxed in the year you return as if you'd never gone. And this April, the government quietly shut the last side door, the one where dividends paid from profits you earned after leaving escaped the claw back. Gone, leave, empty the company, nip back, now fails in full. 3. The one nobody plans for. Inheritance tax follows you out of the door. Since April 2025, it runs on residents. And if you've lived here long enough, your whole worldwide estate stays inside British inheritance tax for up to 10 years after you leave. The treaty doesn't touch it. It doesn't cover inheritance tax at all. So a lifelong British resident who moves to Dubai tomorrow is looking at a decade before the estate is actually out. That's not a loophole problem. That's a planning problem. And it's measured in years, not paperwork. Here's where it lands. The treaty was never the story. The residence test is the story. The treaty is a tiebreaker, a pensions win, and some protection for business trips. Everything else people credit it with is actually the day counting. Done right, held for years. Joshua's move works on paper because the paper is real. Filings, residence, and a business that stayed put and kept paying its British tax. And if he ever tops the bill at Wembley again, Britain gets its cut of that night no matter what his passport stamps say. Same rules for him as for you. The ring decides, the days decide, and the estate takes a decade to follow. 2 ways to work with me, both linked below. If there's real money on the line and you want the structuring conversation, apply for a call. That's CT Private Office. And if you just want your company handled properly every month, the accounts, the payroll, the filings, the tax for pros packages page is below too. Flat monthly price, pick the one that fits, and you're set up this week. If this told you something your accountant never has, subscribe. There's one of these every week, like it if it earned it. And if it landed, hit the hype button under this video on the YouTube app. It costs you nothing, and it tells YouTube to show this to more people who need it. Would you leave? Tell me below, yes or no. Thanks for watching. Every like, comment, hype, and subscribe genuinely helps us keep making these, and it costs you nothing.